All right, today we are pulling back the curtain on the financial markets. We're going to build a super practical cheat sheet using a method called volume spread analysis, or VSA. The whole point? To decode the secret language of the pros, to understand what the big players are really up to. Okay, let's get right into it.
You know, for so many people, looking at a stock chart feels like staring into chaos. It's just this jumble of red and green bars that seem to move with absolutely no rhyme or reason. But what if it's not random? What if there's a hidden logic to it all? What if you could actually read the story being told bar by bar?
Well, to understand that story, first you've got to meet the characters. On one side, you have the crowd. Now, that's most of us, right? We often make decisions based on pure emotion. You know, the fear of missing out when things are flying high, or panic selling when everything's crashing. But on the other side, you have the smart money. Think large institutions, professional syndicates. They operate on cold, hard logic, and they live and breathe the laws of supply and demand.
So how do we get a peek into what the smart money is thinking? How do we stop trading with emotion and start trading with their kind of logic? Well, the secret, it lies in a language that most people completely ignore.
Think about it. Every single time these huge institutions make a move, whether they're buying or selling massive positions, they can't help but leave footprints. And those footprints? They're right there, visible in the trading volume. Volume is the fuel. It's the energy behind every single price move. And if we analyze it, we can start to see what the pros are doing, hiding right there in plain sight.
And this is exactly where volume spread analysis, or VSA, comes in. VSA is simply the art of interpreting these footprints. Now, this isn't about some fancy, complicated indicator that's always late to the party. Nope. It's about looking at just three things: how wide a price bar is, where it closes, and this is the most important part, the volume behind it. That combination tells us the true story of supply and demand.
Now, this right here, this is the universal law behind all of VSA, effort versus result. Just think of volume as the effort being put in to move the price. And the price candle itself, that's the result. So, if you see a massive effort, huge volume, but you get a tiny result where the price barely moves, something is up. That's a huge clue that a powerful opposing force is absorbing all that pressure. This one idea is the core of everything we're about to look for.
Okay, let's put this into practice. We're going to start building the first half of our cheat sheet. Let's break down the exact playbook the smart money uses to load up on positions when pretty much everyone else is selling in a panic.
We're going to zero in on three key bullish signals from our cheat sheet. First, no supply, which is a dead giveaway that the sellers have just vanished. Then, the Springer Shakeout, which is a classic professional trap. And finally, the selling climax, which is where smart money basically absorbs pure panic to build a new base.
First up is no supply. Here's the simple if/then logic from our cheat sheet. If the price drifts down to a previous low point, a support level, and you see the volume just completely dry up, it just dies, then you look for a chance to go long. And why? Because it's a huge sign that selling pressure is totally exhausted. There's nobody left who's willing to sell at these prices. And that means the path of least resistance has just flipped to the upside. Next, we have the shakeout or the spring. Now, this one is way more aggressive. It's a deceptive move. You'll see this sharp, scary-looking drop right below that key support level we just talked about. It's often timed with some bad news you see in the media. All the retail traders freak out, their stop-loss orders get triggered, and it looks like a total disaster. But what's really going on here? Just look at this example. See that sharp dip below the support line? The volume is definitely high, but look at where that price bar closes, way back up near its high. This tells a super clear story. The if is the dip below support. The then is that fast recovery on the very same bar. And the why? Well, this wasn't a random move. It was a calculated trap by smart money to hunt those stop losses, absorb all that panic selling, and grab a bigger position before they send the price rocketing higher.
And finally, the grand finale of a downtrend, the selling climax. This is peak fear, max panic. You see a brutal price drop on absolutely massive climactic volume. The public is capitulating, they're dumping everything they own. And who's on the other side of that trade? The smart money. They are calmly putting out a bucket and absorbing this flood of selling, building the foundation for the next big rally. It's the ultimate sign of strength, but you don't jump in right away. This is your signal to start watching very, very closely for a safer entry, like a no supply test.
Okay, so we've seen how they buy low by absorbing fear, but it's just as crucial to understand how they sell high by using greed to their advantage.
So now we flip the script and see how the pros distribute their shares to an unsuspecting public, right at the very top of the market.
And what you'll see here is that the bearish signals are pretty much mirror images of the bullish ones. Our cheat sheet for selling high includes no demand, the nasty upthrust trap, and the euphoric buying climax.
First, a no demand bar. If the price kind of drifts up towards a previous peak, a resistance area, but the volume is just pathetic, then you look for a short. So why? Because it's showing you there's no real professional buying power behind this move. The market is basically rising on fumes just because the sellers have taken a little break, and that makes it incredibly vulnerable to a sudden drop.
Then you've got the upthrust. This is the ultimate bull trap. The price breaks out above a really clear resistance level, and every trader who loves to buy breakouts gets super excited and jumps in. But the move instantly fails and the price slams back down below that resistance level. See, this wasn't a real breakout. It was manufactured. It was designed purely to attract buyers so the smart money could unload their positions to them at the highest possible prices.
And at the very top, you get the buying climax. After a long, beautiful uptrend, the market just parabolic. You see this huge price spike up on the highest volume you've seen in months. This is peak greed. It's pure euphoria. The public is piling in, convinced it's going to the moon, and this is the exact moment smart money uses to distribute or sell the last of their huge holdings into that massive wave of excitement.
But hey, it's not always about buying or selling. Sometimes the most profitable move you can make is to do nothing at all. Our VSA cheat sheet also has some really clear warning signs for when the market is conflicted, and it's probably best to just stay on the sidelines.
The first big warning sign is that effort without result concept we talked about. If you see gigantic volume, but the price bar is tiny and goes nowhere, it means a titanic battle is happening. A huge seller is meeting a huge buyer, and trust me, you do not want to get caught in that crossfire. The second sign is the chop zone. This is when the price is just drifting sideways with kind of average volume. It means there's no clear institutional direction. In these cases, cash is your safest position. So after building out our cheat sheet with all these specific signals, let's just zoom out for a second and finish with the one single principle that ties everything together. This is the golden rule you can apply to any chart, in any market.
It really does always come back to this one question. Every single time you look at a price bar, just ask yourself, is the effort in harmony with the result? If you see super high volume, that's a lot of effort, you should expect to see a big price move. If you don't, that's a divergence and a major clue. If you see a big price move on really low volume, that's another clue. Asking this simple question will force you to see the market in a completely new way.
So you see, the market isn't just random noise. It's a story of supply and demand, of fear and of greed, and it's written bar by bar. By learning to read volume, you're learning to see the footprints of the professionals. So the question now is, with this cheat sheet in hand, what stories are you going to find?